The market bought AI infrastructure like a single bet. One ETF, one thesis, one trade. But the research doesn't see one trade. It sees a fault line running straight through the basket. On one side, companies structurally capturing AI-driven profit. On the other, names that are exposed to the cycle, priced as if execution is guaranteed and nothing goes wrong. Sandisk just posted plus 97% sequential revenue growth. That number is real. The question is whether the rest of the basket deserves to trade alongside it. The industry cycle read from AlphaOS places computer hardware in early recovery, expected to run 6 to 12 months, with strong momentum and an earnings intelligence score of 77 out of 100. That earnings score matters. It means recent prints are beating expectations, not just meeting them. Capital flows are tracking an ETF momentum proxy, which signals institutional money is still rotating in, not out. The demand score sits at 52, which sounds modest, but in early recovery, that's exactly the setup. Demand is real and still building, not yet priced to perfection. The growth score of 62 and a valuation score of 65 together tell you the cycle has room, but the market is already paying for some of it. The outlook reads neutral, which is the research's way of saying the macro tailwind is confirmed but not guaranteed to lift every name equally. That gap between the cycle being real and every company in the basket deserving credit for it, that's where this film lives. Snowflake is the data infrastructure layer sitting directly underneath enterprise AI workloads. In Q1 fiscal 2027, revenue grew 33% year-over-year to $1.39 billion, and management raised full-year guidance from 27% growth to 31%, citing meaningful adoption of AI capabilities, including Snowflake Intelligence and Cortex Code. The net loss narrowed sharply, and non-GAAP product gross margin held at 75.1%. The catch is that continued acceleration depends on AI product adoption holding. If enterprises slow their AI deployments, Snowflake's guide raise story unwinds fast. Alphabet's Google Cloud segment posted plus 63% revenue growth year-over-year against a total company top line near $119.8 billion. That cloud number is the AI infrastructure story inside an advertising business. The risk the research flags is concentration. If advertising softens, cloud's momentum gets overshadowed by the income statement, and the market reprices the whole thing as an ad company again. Sandisk's plus 97% sequential revenue growth on roughly $9 billion in revenue is the most violent single-quarter print in this basket. Flash storage is the infrastructure layer that actually scales with AI data volumes. The catch flagged in the research is execution risk around its planned spin-off of the flash business. A transaction that, if it goes sideways, puts a discount on the exact asset that earned that growth number. TERADYNE is the semiconductor test equipment provider, the company that validates the chips before they go into AI servers. Q2 2026 revenue hit $1.33 billion, driven by $1.12 billion from semiconductor test alone. Management raised Q3 guidance and pointed explicitly to AI-related demand as the driver. The research also flags a year-over-year revenue decline of 59.9%, which reflects the cyclicality in test equipment. Demand comes in waves tied to chip production cycles, not steady-state AI spend. Here is the analyst's read. Snowflake and Alphabet's cloud arm are structurally capturing AI profit. Their revenue acceleration is tied to enterprises actually spending on AI workloads, and both raise guidance on the back of it. Sandisk's print is the loudest number in the basket, but the spin-off execution risk is real and unresolved. TERADYNE is the most cyclically exposed name here. Test equipment demand follows chip production cycles with a lag, so the AI tailwind is real but lumpy, and a reported year-over-year revenue decline of nearly 60% is not a detail to wave away. The market is pricing the whole basket as if AI spend is linear, and every company captures it proportionally. The research says it isn't, and they don't. The early recovery cycle stage with a risk score of 60 tells you this trade has room, but also that the spread between the names that capture the profit and the names that are merely in the neighborhood is about to widen. The single risk that breaks the whole theme is valuation compression at the cycle turn. The industry valuation score of 65 out of 100 means the basket is not cheap. If AI enterprise spending growth decelerates even slightly, Or if hyperscaler capital expenditure guidance disappoints, the multiple on every name in this basket contracts simultaneously. The risk score of 60 confirms this is not a low-risk setup. Early recovery cycles can stall. And when a basket is priced for a smooth continuation, a stall doesn't feel gradual. It reprices hard and fast across names that had very different underlying fundamentals. The full AI infrastructure theme, cycle stage, company-level prints, capital flow signals, is live on AlphaOS. Explore it at alphaos.finance. Research and analysis only, not investment advice.